Let me ask you something that's going to make you uncomfortable. When was the last time you actually looked at what's happening to the money sitting in your savings account? Not just the balance, but what's really happening to its purchasing power while it sits there earning what? 0.5%? Maybe 1% if you're lucky. Because while you've been playing it safe, something has fundamentally broken in the financial system. And the people who understand what's coming aren't keeping their wealth in dollars anymore. They're moving into something that's been protecting wealth for 5,000 years. I'm talking about gold. And before you roll your eyes and think this is just another precious metals pitch, I need you to understand what's happening right now in the gold market. Because the setup we're seeing is unlike anything we've witnessed in decades. And the people who miss this are going to watch their purchasing power evaporate. Let's start with what's actually happening to your savings account. You've got money sitting there, maybe earning 1% annually. Feels safe, right? FDIC insured. No volatility. You can sleep at night. But here's what they're not telling you. While your account balance stays the same, the value of every dollar in that account is being systematically destroyed. The official inflation numbers say 3%, maybe 4%. But anyone who actually buys groceries, pays insurance premiums, or fills up their gas tank knows those numbers are fiction. Real inflation, the kind you experience when you're trying to maintain your standard of living, is running somewhere between 8 and 12% annually, which means that savings account earning 1%, you're losing 7 to 11% of your purchasing power every single year. Think about what that means over a decade. $100,000 in savings today will have the purchasing power of maybe $40,000 in 10 years. You didn't spend a dime. You were responsible. You saved. And you still lost 60% of your wealth. That's not safety. That's slow-motion financial suicide. But it gets worse. Because what's causing this inflation isn't going away. It's accelerating. And the people running the system know it. That's why they're quietly moving their wealth into hard assets while telling you to keep your money in the bank. Let me show you what I mean. In the last 3 years, central banks around the world have purchased more gold than at any point since 1950. We're talking about the institutions that print money, that control monetary policy, that have access to every economic data point you can imagine. And they're dumping dollars and buying gold at a pace that should terrify anyone paying attention. China's central bank has been buying gold for 17 consecutive months, not slowing down, not taking a break. 17 months of continuous accumulation. The People's Bank of China added over 300 tons to their reserves in the last year alone. And those are just the official numbers. Most analysts believe China's actual gold holdings are 2 to 3 times higher than what they report. Why would they hide it? Because if the world knew how much gold China was actually accumulating, it would trigger a panic into precious metals that would send prices vertical overnight. They're trying to accumulate as much as possible before the rest of the world figures out what's happening. Poland's central bank has increased their gold reserves by 200 tons in the last 2 years. Singapore has been quietly building their position. India just repatriated 100 tons of gold from the Bank of England, bringing it back home where they can actually control it. Even countries you've never heard of are loading up on gold like their currency depends on it. Because it does. These aren't dumb people. These are the most sophisticated financial institutions on the planet. They have economists, analysts, and strategists who understand the global monetary system better than anyone, and they're all doing the same thing. They're getting out of dollars and into gold as fast as they can without causing a panic. Now ask yourself, what do they know that you don't? Here's what they know. The dollar's role as the world's reserve currency is ending. Not might end, not could end, is ending. Right now, in real time. And when that happens, every dollar you own is going to lose value so fast it'll make the last 3 years look like nothing. For the last 50 years, since Nixon took us off the gold standard in 1971, the dollar has been backed by nothing except the promise that other countries would keep using it for international trade. That system worked as long as everyone played along. As long as oil was priced in dollars. As long as countries needed dollars to buy commodities. As long as the U.S. maintained military and economic dominance that made it too risky to challenge the system. But that era is over. And the cracks aren't just showing. The whole structure is collapsing. The BRICS nations, Brazil, Russia, India, China, South Africa, are building an alternative financial system that doesn't use dollars. They're settling trade in their own currencies. They're creating their own payment systems that bypass SWIFT. They're talking openly about a gold-backed trade currency that would compete directly with the dollar. Saudi Arabia, the country whose oil sales have backed the dollar for 50 years, just announced they're open to selling oil in currencies other than dollars. Let that sink in. The petrodollar, the foundation of dollar dominance, is being dismantled right in front of us. Russia and China are settling their trade in rubles and yuan. India is buying Russian oil in rupees. Brazil and China are trading in their own currencies. The UAE is accepting rupees for oil. Every single one of these transactions used to require dollars. Now they don't. And every time a trade happens without dollars, the demand for dollars drops. And when demand drops, value drops. It's basic economics. Except we're not talking about a consumer product. We're talking about the currency your entire life savings is denominated in. The people who understand this are moving their wealth into assets that can't be printed, that can't be devalued by central bank policy, that have maintained their purchasing power through every currency crisis in human history. They're buying gold. But here's where it gets really interesting, because it's not just central banks. The smart money, the institutional investors who move markets, are piling into gold in ways we haven't seen since the financial crisis. Hedge funds have increased their net long positions in gold futures to levels not seen since 2020, right before gold ran from $1,800 to over $2,000 an ounce. These are the guys who manage billions of dollars. They don't make emotional decisions, they follow the data, and the data is screaming that gold is about to make a major move higher. Gold ETFs, the funds that hold physical gold for investors, saw inflows of over $3 billion in the last quarter alone. That's real money coming into the market from institutional investors who are positioning for what's coming next. Even the big banks, the ones who have been bearish on gold for years, are changing their tune. Goldman Sachs just raised their gold price target to $2,700 an ounce. JP Morgan is telling clients to increase their gold allocation. Bank of America published a report saying gold could hit $3,000 within 18 months. These banks don't make bullish calls on gold unless they're absolutely certain the trend is in place. They have too much reputation risk. The fact that they're all saying the same thing at the same time should tell you everything you need to know about where this market is headed. Now, I want to take a quick 30-second detour here, because this is relevant if you're sitting on a significant amount in retirement accounts. If you've got $100,000 or more in a 401k or IRA, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. You'll find it in the description below. It covers the process, the rules, the companies that handle it, everything you need to know. Worth checking out if that applies to your situation. All right, back to what's happening in the gold market right now, because the supply and demand dynamics are setting up for a price move that could dwarf anything we've seen in the last decade. Let's talk about supply first. Gold is getting harder and harder to find. The easy deposits have been mined. The big discoveries that used to happen every few years aren't happening anymore. The last major gold discovery was over a decade ago, and it takes 7 to 10 years to bring a new mine into production even if you find something. Global gold production peaked in 2018 and has been declining ever since. We're mining less gold every year while demand is exploding. That's not a recipe for stable prices. That's a recipe for a supply squeeze that sends prices vertical. And it's not just about finding new gold. The cost of mining existing deposits is skyrocketing. Energy costs are up. Labor costs are up. Equipment costs are up. Environmental regulations are getting stricter. The all-in sustaining cost for gold miners, the amount it costs to pull an ounce of gold out of the ground, is now over $1,300 per ounce for most producers. Gold is trading around $2,000 an ounce right now. That sounds like a healthy margin, but when you factor in exploration costs, development costs, and the fact that ore grades are declining, meaning they have to process more rock to get the same amount of gold, those margins are getting squeezed, which means at current prices, a lot of marginal mines aren't economical. They're shutting down, which means even less supply coming to market, which means the supply deficit gets worse. Now let's talk about demand, because this is where things get really interesting. Central bank demand is at record highs and showing no signs of slowing down. We already talked about China, Poland, Singapore, India. But it's not just them. Turkey bought 30 tons last quarter. The Czech Republic is building their gold reserves. Even Uzbekistan is buying gold. Countries that have never cared about gold are suddenly loading up. Why? Because they see what's coming. They see the dollar losing its reserve status. They see inflation spiraling out of control. They see the risk of holding paper assets in a system that's breaking down, and they're protecting themselves the only way that's worked throughout history. But central banks are just one source of demand. Jewelry demand, particularly from India and China, remains incredibly strong. These cultures have understood the value of gold for thousands of years. When people in these countries get wealthier, they buy gold. It's not an investment decision. It's cultural. It's how they store wealth across generations. India imports over 800 tons of gold every year for jewelry and investment. China's jewelry demand is over 600 tons annually. That's 1,400 tons of gold coming off the market every year just from those two countries. And their middle classes are growing, which means that demand is going to increase, not decrease. Then you've got industrial demand. Gold isn't just for jewelry and investment. It's used in electronics, in medical devices, in aerospace applications. Every smartphone has gold in it, every computer, every car with advanced electronics. As technology advances, industrial demand for gold increases. And finally, you've got investment demand from regular people who are starting to wake up to what's happening. People who are watching their savings lose value. People who are worried about inflation. People who don't trust the banking system anymore. They're buying gold coins, gold bars, gold ETFs. And that demand is accelerating. So you've got declining supply and exploding demand from multiple sources. Central banks, jewelry buyers, industrial users, and retail investors all competing for a finite amount of gold. What do you think happens to the price? But here's what makes this setup even more explosive. The paper gold market. Most people don't realize this, but the gold market is massively leveraged. For every ounce of physical gold that actually exists, there are probably 100 ounces of paper gold trading in the futures market. These are contracts that represent gold, but there's no actual metal backing them. It's just paper promises. This works fine as long as everyone's happy trading paper. But what happens when people start demanding physical delivery? What happens when investors say, "I don't want a contract, I want the actual gold"? That's when the system breaks. Because there isn't enough physical gold to deliver against all those paper contracts. Not even close. And when that realization hits the market, when the paper gold market gets exposed as the fraud it is, the price of physical gold is going to explode. We've already seen hints of this. In March 2020, during the COVID panic, the spread between paper gold and physical gold blew out to over $100 an ounce. You could buy gold futures for $1,600, but if you wanted actual physical gold, you were paying $1,700 or more. The paper market and the physical market disconnected. That was a warning shot, a preview of what's coming. Because when the real crisis hits, when confidence in the financial system really breaks down, that spread isn't going to be $100. It's going to be $500, $1,000, maybe more. And if you're holding paper gold, you're going to find out real fast that it's not the same as holding the actual metal. This is why central banks are buying physical gold and repatriating it from foreign vaults. They understand that when the crisis comes, paper promises aren't going to cut it. You need to have the actual metal in your possession. Let me give you a historical parallel that should scare you. In 1971, when Nixon closed the gold window and ended dollar convertibility to gold, gold was trading at $35 an ounce. Within 9 years, by 1980, gold hit $850 an ounce. That's a 2,300% increase. Why did that happen? Because the world lost confidence in the dollar. Because inflation spiraled out of control. Because people realized that paper currency backed by nothing was going to lose value. So they rushed into the only asset that couldn't be printed, that couldn't be devalued, that had maintained its purchasing power for thousands of years. We're in the exact same setup right now. Actually, it's worse. Because in 1971, the U.S. was still a creditor nation. We still had a trade surplus. We still had manufacturing. We still had a strong economy. Now, we're the world's largest debtor. We run trillion-dollar deficits every year. We've offshored our manufacturing, and we're printing money at a pace that would have been unthinkable in the 1970s. If gold went up 2,300% in the 1970s under much better conditions, what do you think it's going to do now? If you apply the same percentage move to today's gold price of $2,000, you're looking at gold over $45,000 an ounce. Now, I'm not saying it's going to go that high, but even a fraction of that move would represent life-changing wealth for anyone positioned correctly. And here's the thing. You don't need gold to go to $45,000 to protect your wealth. You just need it to keep pace with real inflation. If gold goes to $5,000 an ounce over the next few years while your savings account loses half its purchasing power, you've just preserved your wealth while everyone else got destroyed. That's what gold does. It's not about getting rich quick. It's about not getting poor slowly. It's about maintaining your purchasing power when everything else is losing value. But there's another angle to this that most people miss. Gold isn't just going up because of inflation and currency debasement. It's going up because the entire financial system is built on a foundation of debt that can never be repaid. The U.S. national debt is over $34 trillion. That's trillion with a T, and it's growing by over $1 trillion every year. There is no scenario where that debt gets paid back. None. The only way out is to inflate it away, to devalue the currency until the debt becomes manageable in nominal terms. But it's not just government debt. Corporate debt is at record highs. Consumer debt is at record highs. Student loan debt, credit card debt, auto loan debt, mortgage debt. The entire economy is drowning in debt. And when you have this much debt in the system, there are only two options: default or inflate. Default means depression, bank failures, mass unemployment, social unrest. No politician is going to choose that. So they're going to choose inflation. They're going to print money. They're going to keep interest rates artificially low. They're going to do whatever it takes to keep the system from collapsing, even if it means destroying the currency. And when they do that, when they choose inflation over default, gold is going to be the only asset that protects you. Because gold can't be printed. Gold can't be devalued by central bank policy. Gold is the ultimate inflation hedge. Look at what happened in Venezuela, in Zimbabwe, in Weimar Germany, in every hyperinflationary collapse throughout history. The people who held their wealth in the local currency got wiped out. The people who held gold maintained their purchasing power and came out the other side with their wealth intact. You might be thinking, that can't happen here. We're America. We're different. But that's what everyone thinks right before their currency collapses. The Germans thought they were different. The Venezuelans thought they were different. Every failed currency in history was backed by people who thought it couldn't happen to them. The difference between those countries and the U.S. is that when the dollar collapses, it's going to take the entire global financial system down with it. Because the dollar isn't just America's currency, it's the world's reserve currency. It's the foundation of international trade. When it goes, everything goes. And the people who are prepared, who have moved their wealth into hard assets, into gold, are going to be the only ones left standing. Now, I want to talk about timing. Because you might be thinking, okay, I understand the thesis. I get why gold is going higher. But when? When is this going to happen? Here's the truth. Nobody knows the exact timing. But what we do know is that the setup is in place. The fundamentals are screaming that gold should be much higher. The technical charts are showing a major breakout pattern. The institutional money is positioning for a big move, and the catalysts are lining up. We've got a banking crisis that's not over. We've got commercial real estate imploding. We've got geopolitical tensions escalating. We've got an election coming up that's going to be contentious no matter who wins. We've got a Federal Reserve that's trapped between fighting inflation and preventing a recession. Any one of these could be the trigger that sends gold vertical. But here's what you need to understand. By the time it's obvious to everyone that gold is the place to be, it's going to be too late. The price is going to gap up so fast that you won't be able to get in at reasonable levels. The premiums on physical gold are going to explode. The dealers are going to run out of inventory. You're going to be competing with millions of other people who all figured it out at the same time. That's how these moves work. They happen slowly, then all at once. Gold grinds higher for months or years, and then suddenly it goes parabolic and doubles in a matter of weeks. And if you're not positioned before that happens, you miss it. The smart money is positioning now, while gold is still under $2,100. While physical premiums are still reasonable, while you can still get size without moving the market. They're not waiting for confirmation. They're not waiting for gold to hit $3,000 before they buy. They're buying now, while everyone else is still asleep. And look, I get it. It's scary to move money out of your savings account. It feels safe there. You can see the balance. You can access it any time. It's FDIC insured. But that safety is an illusion. Because while your account balance stays the same, the value of every dollar in that account is being destroyed. Gold feels risky because it's volatile. The price moves up and down. You can't spend it at the grocery store. It doesn't pay interest. But over any meaningful time period, gold has preserved purchasing power better than any paper currency in history. That's not opinion. That's fact. In 1971, an ounce of gold could buy you a nice men's suit. Today, an ounce of gold can still buy you a nice men's suit. The purchasing power hasn't changed. But if you held dollars over that same period, you'd need 30 times more dollars to buy the same suit. That's the difference between real money and paper currency. So the question isn't whether you can afford to buy gold. The question is whether you can afford not to. Because every day you wait, every day you keep your wealth in dollars, you're losing purchasing power. You're betting that the system is going to hold together, that inflation is going to come down, that the dollar is going to maintain its value. And all the evidence says that's a losing bet. The central banks know it. The institutional investors know it. The smart money knows it, and now you know it. The only question is what you're going to do about it. You can keep your money in a savings account earning 1% while inflation runs at 10%. You can watch your purchasing power evaporate year after year. You can hope that somehow things are going to get better, that the people running the system are going to fix it. Or you can do what the smart money is doing. You can move a portion of your wealth into an asset that's been protecting purchasing power for 5,000 years. You can position yourself for the massive wealth transfer that's coming. You can be on the right side of the trade when the dollar's reserve status ends and gold reprices to reflect its true value. This isn't about getting rich. This isn't about speculation. This is about survival. This is about protecting everything you've worked for from a monetary system that's in the process of collapsing. And the window to position yourself is closing fast. Because once this move starts, once gold breaks out and the mainstream figures out what's happening, it's going to be too late. The price is going to gap up. The physical market is going to lock up. And you're going to be stuck watching from the sidelines while your savings account loses half its value. Don't let that happen. Don't be the person who understood what was coming but didn't act. Don't be the person who kept their wealth in dollars because it felt safe, only to watch it evaporate when the crisis hit. The people who are going to come out of this okay are the ones who are taking action now, who are moving their wealth into hard assets, who are buying gold while it's still under $2,100 and physical premiums are still reasonable, who are positioning themselves before the crowd figures it out. Your savings account isn't safe. It never was. It's just been losing value slowly enough that you didn't notice. But that's changing. The pace of currency debasement is accelerating. And if you don't protect yourself now, you're going to wake up one day and realize that everything you saved, everything you worked for, is worth half of what it used to be. Gold is the answer. It's been the answer for 5,000 years, and it's the answer now. The only question is whether you're going to act on that knowledge or whether you're going to keep hoping that somehow this time is different.